Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at QXO.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
Okay, so imagine a company that's generating $57 million in revenue one year and then $6.8 billion the next year.
Yeah, it literally sounds like a typo in the financial filings.
Right. Like you don't get that kind of growth by just organically planting seeds and, waiting for them to grow.
No, absolutely not. You get it by basically becoming an apex predator in your industry.
Exactly. So that's our hook today. We are unpacking this massive, super aggressive corporate strategy that is playing out right now in a highly fragmented $800 billion market.
And honestly, it's a market most people don't think about.
All right, let's move into the wealth building context.
So we're talking about the U.S. building products distribution sector.
Which means, moving drywall, roofing supplies, lumber across the country.
Right. It is the definition of an unglamorous legacy market. But what QXO is doing inside it is it's anything but boring.
It's basically a masterclass in this hypergrowth roll-up strategy.
Exactly. And to understand how you jump from $57 million to almost $7 billion in one single year, you have to look under the hood.
Because, you don't engineer that kind of revenue explosion without a catalyst.
Right. And the short answer for that huge jump is their acquisition of Beacon Roofing Supply.
That was the big one. That essentially transformed QXO from this little blip on the radar into a multi-billion-dollar platform overnight.
Yeah, I mean, by the fourth quarter of 2025 alone, their net sales crossed $2 billion.
But, there's a catch there. Now let's look at the fundamentals.
Because if you're actually scanning their financial statements from that quarter, you run into this massive contradiction.
Yeah, it trips up a lot of casual observers.
Definitely. Despite moving billions in supplies, QXO actually reported a GAAP basic and diluted loss per share.
They were officially in the red.
Right. But in that exact same earnings report, their adjusted earnings per share actually showed a profit.
So I was trying to wrap my head around this discrepancy, and tell me if this analogy works.
Sure, go for it.
Looking at their GAAP numbers is it's kind of like looking at the bank account of someone who just bought this massive fixer-upper apartment building.
Okay, yeah.
The upfront costs, the closing fees, the initial renovations, they look terrifying on paper.
The bank account
just looks completely drained. But if you look at the adjusted numbers, it's like looking at the rental income that the building is already generating month over month.
I like that.
Yeah, because the pure cash flow tells a completely different story than the accounting reality of the purchase.
No, that analogy perfectly captures the mechanics of what's happening.
Awesome.
Because when you execute these massive M&A deals, the accounting rules actually force you to write down or amortize the value of the intangible assets you just bought.
Like what kind of asset?
Like customer lists or brand value, and that creates this massive expense on paper, which drags your official GAAP net income into negative territory.
Got it. So the adjusted EPS just strips all that out.
Exactly. It isolates the underlying business, your rental income, to show what the core engine is actually producing.
And QXO really needs that engine running perfectly because management laid out this long-term goal that just borders on absurd.
Oh, it's wildly ambitious. They aren't stopping at $7 billion.
Right. By the 2032 to 2035 timeframe, they want to hit $50 billion in annual revenue.
And pulling in 13% margins, which is huge.
But to achieve that in building products, you have to build an impenetrable competitive moat. Which is hard, because how do you do that in an industry that essentially boils down to just moving heavy materials from point A to point B?
Well, you build it by forcing scale onto a very decentralized world.
Because the industry is super fragmented.
Extremely. It's filled with thousands of regional mom-and-pop distributors. So by rolling them all up under one umbrella, QXO gets massive pricing power.
Right. A local distributor in Ohio just can't negotiate the same bulk discount from a drywall manufacturer that a $50 billion national behemoth can.
Exactly. But the real moat is the tech. They're flattening these old organizational structures and injecting proprietary tech into procurement, pricing, logistics, everything.
So basically, they buy a regional distributor who might still rely on, I don't know, a guy named Gary with a clipboard,
Poor Gary.
Right. Gary knows local lumber prices in his head.
Mm.
But QXO comes in, takes the clipboard, and puts in a dynamic tech stack.
Yeah, one that updates pricing based on real-time national data.
It instantly optimizes delivery routes and automates inventory. You take a low-margin legacy business and make it highly profitable.
And that technology acts as like an invisible trap for the customer base.
How so?
Once a major contractor gets used to that level of service-perfect logistics, reliable inventory, better pricing, they aren't going back to the competitor down the street using a fax machine.
The switching cost is basically psychological.
Exactly. But buying these players and modernizing them burns so much cash.
Right. Which makes you wonder, how do they fund a $50 billion march without drowning in debt?
Well, that comes down to the architect of this whole thing, CEO Brad Jacobs.
He's got some serious skin in the game, right?
Oh, yeah. He holds a 49% personal ownership stake.
Wow.
So he's not just a hired gun collecting a corporate salary. His wealth is entirely tied to this succeeding.
And he's got major backing. Like, in January 2026, Apollo Global Management dropped a $1.2 billion capital infusion into QXO.
Which is massive institutional validation. Private equity firms of that size stress test every assumption before writing a billion-dollar check.
Right. And that fortifies their balance sheet. They're sitting on over $2 billion in cash against roughly $3.7 billion in long-term debt.
And looking at cash flow, in just Q4 2025, they generated over $186 million in operating cash flow.
That brings us to the catalyst timeline, because this cash flow acts as a self-funding mechanism for what's next.
Right. They acquire a business, it throws off cash, and that funds the next target.
But the scale of these next targets is just insane. We're
Yeah.
looking at Kodiak Building Partners closing early Q2 2026.
Yeah.
But the absolute monster is TopBuild, a $17 billion deal expected to close in Q3.
Taking down a $17 billion target is a total paradigm shift.
But wait, what about the Q1 2026 earnings before that?
Right. Estimated for late July or early August, analysts are going to look past the headline numbers and focus on the organic growth of the legacy Beacon business.
They need to know the core asset isn't rotting while management is distracted by these mega deals.
Exactly. And hanging over all this is the macro environment. High mortgage rates have basically frozen residential housing.
Yeah, the whole $800 billion industry is trying to sprint with weights tied to its ankles.
But you have to view that macro headwind as a coiled spring. Housing is cyclical. We're in a trough. QXO is using this downtime to buy up the distribution network at a discount.
So when rates drop and builders start pulling permits again, QXO owns all the toll roads.
Exactly. They'll capture a massive cyclical revenue surge on top of their new market share.
Now let's pivot to the chart, because we need to see how the market is digesting all this.
Well, the first thing is the volatility. The stock carries a beta of 2.50.
Wow, so it moves 2.5 times as aggressively as the broader market.
Yeah, we saw it hit a 52-week high in the upper 20s, then suffer a nearly 19% pullback in March.
But that wasn't a structural failure, right? It was just an M&A pause.
Exactly. The market got so used to constant deals that a quiet period caused a sell-off. But technically, the stock is consolidating nicely now.
It's building a support shelf in the low 20s, with the 50-day moving average hovering around $22.
And the volume tells a huge story.
Yeah, on April 20, 2026, QXO had this massive volume spike. Over 11 million shares traded a 41% jump.
Right, directly linked to the TopBuild news. When you see volume like that, it's institutions moving capital.
So what does market sentiment look like?
Institutional ownership is exceptionally strong at nearly 59%.
So the smart money is heavily involved.
Well, definitely. Royal Bank of Canada raised its position by over 67% in Q1 2026. UBS, AQR Capital Management, Millennium Management, they're all aggressively adding.
Having quant funds and traditional banks piling in is a great sign.
And analysts agree. It's got a moderate buy consensus with an average price target around $32.40, backed by Oppenheimer and KeyCorp.
Now let's talk about the risks, because this isn't a guaranteed home run.
Far from it. TopBuild is a massive insulation distributor. Integrating thousands of workers and fleets of trucks is an operational minefield.
And the financing raises red flags. It's a complex mix of cash, stock, and new debt. Issuing new stock for a $17 billion deal heavily dilutes existing shares.
Yeah, taking on new debt alters that pristine balance sheet we just praised. It's even triggered a shareholder rights investigation.
Which happens with complex mega deals, but still.
Yeah.
And the integration drag is already showing up. QXO operates with a negative net margin of roughly 4%.
Right, and a deeply negative PE ratio. Merging IT and HR departments without disrupting deliveries is expensive.
It drags down margins violently in the short term.
Yeah.
But wait, I have to ask about human psychology here. Deal fever.
Ah,
If
yes.
Jacobs is so hyper-focused on $50 billion, isn't there a massive risk he gets impatient and overpays just to hit a revenue target?
It's a fair question, but Jacobs actually has a track record of walking away. Yeah. He was in a fierce bidding war for a company called GMS. He calculated his absolute ceiling for value creation was $95 per share. Home Depot swooped in and bid $110.
Checking your ego in a multi-billion-dollar bidding war is rare. Most CEOs would match that.
He simply walked away and let Home Depot overpay. That level of discipline is why the smart money trusts him.
So with everything on the table, what's the final verdict?
The research gives QXO an 8 out of 10 bullish score, but it is specifically framed as a multi-year hold.
Right. You aren't buying this for a quick quarterly pop.
No, you buy to partner with a proven management team as they scale toward that $50 billion target. You have to endure the messy JAP accounting charges and wait for the true operational leverage to shine through.
It really is an incredible story. From a $57 million blip to a $7 billion heavyweight in a year.
And it leaves you with a really provocative thought.
Oh, what's that?
If QXO proves you can take a fragmented, unglamorous industry like building products and completely revolutionize it with centralized tech and aggressive M&A.
What other boring legacy sectors are ripe for a tech-enabled roll-up?
Exactly. Are we entering an era where Silicon Valley-style operational efficiency completely rewrites blue-collar supply chains?
That is the multi-billion-dollar question right there. Need emergency cash. MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.